market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, it's a big day for earnings with some of Europe's major banks reporting. We'll tell you how they performed. Of course, it's also Fed Day, and we'll have a preview a little bit later. Now, geopolitics front and center, again, as the uneasy calm in the Middle East is shattered. But it's also the tech story that's, again, driving markets. SK Hynix shares down sharply today after second quarter operating profit missed estimates despite jumping more than 550%. Now, investors are concerned that the firm has earmarked at least $31 billion in capital spending this year. Microsoft will give an update on its data center spending later, while investors, of course, will also hear from Meta's efforts to build a cloud business. Well, we're now joined by Shona, Ghosh, our EMEA tech editor. We're also joined, of course, and to discuss what it all means for markets with Nataliia, Lipikhina, head of EMEA equity strategy at JPMorgan Private Bank. So thank you both for joining us. So look, SK Hynix is a little bit counterintuitive, Shona, because they had some good results, but the shares are getting slammed. Why?
The market's very rational, transpires. So, as you say, that operating income is up more than 500%. These are stellar results. The numbers across the board are excellent, but investors are increasingly concerned when they see capital expenditure from any company going up, particularly when that capex is a record, as it is in this instance. We've seen across other tech companies, not necessarily chip makers, Google moving into negative cash flow as a result of its rising capex. So these rising numbers are increasingly something that investors are scrutinizing alongside growing revenue and profit.
Nataliia, when you look at the sector as a whole, like what exactly is priced in at the moment?
Well, I think back to what you were saying, good morning, I think the market is just trying to rationalize and really scrutinize the capex increase and also what it means for the return on those investments. It can be revenues, it can be operating profit, it can be cloud growth, and I think such a big focus tonight and tomorrow as to what the companies will be delivering. To me, that's probably the story in the markets right now, and the market will definitely be looking into the free cash flow of what those companies are reporting.
But Shona, has anything changed? And if you go back to Google last week or SK Hynix today, it is about growing AI spending concerns, but we've had those. Is there a piece of news that the market is latching onto, or they're just going through the numbers and are becoming restless in terms of the time frame it will take to build it out?
Yeah, so there have been reports that China, which is quite limited in terms of the cutting-edge US chips and European chip-making equipment that it has access to, is maybe able to produce some somewhat cutting-edge, maybe more like mid-tier chip production machines on its own. These are DUV machines, which are mostly produced by ASML out of the Netherlands. ASML has also had stellar performance because it has a stranglehold on this element of the chip production market. But it's very bad news for ASML and some of its related suppliers, and perhaps the broader market, if China is able to produce its own chip-making machinery that could bolster the advances in its AI chips and therefore, be on par with the US and Europe, particularly the US, in terms of amazing AI models, cutting-edge tech. So far, it's a little behind, but we're seeing more and more with the release of K3, for example, the AI model that came out on Monday. These advances are happening quite rapidly. So any even quite small rumor that China is advancing can be enough to send the market sideways.
So I'll ask you in a second how the market or how investors should play this. But actually, what are you expecting from Microsoft and Meta that are reporting later?
Well, again, everyone will be watching capex very closely. These are two of the biggest spenders, both in terms of data center leases, so how long they'll sort of occupy a data center and the rent they'll pay, as well as capex, building those data centers. And investors will be looking quite widely across the board because those costs are split out across different areas of the balance sheet. So I think you'll see quite close scrutiny of the expenditure there.
So, Nataliia, if you're an investor today, how do you look at AI? Do you still are there parts that are unloved, or has everything been bought and overbought?
We still do like the parts of the AI trade. So when we think about different sectors that will benefit, you have hyperscalers, and everyone is very focused on the return on those investments. And when you look into hyperscalers, they actually have underperformed this year. We think to have back that trade, you basically need the hyperscalers tonight, tomorrow, confirming that there is a return on these investments. We believe that if your time horizon is 1 year plus, you're probably in the good place to be. For semis, I think the story is slightly different. For semis, you need to have the confirmation that demand continues to rise. We truly believe and continue to believe that demand is still there. But at this point, I think the market just scrutinizes absolutely everything. And we need to see that there is still confirmation that demand is there. When I take a step back and think about what does it mean for market, we're still constructive on the market. When we look into S&P, for example, we still see upside, 80-100 by mid-2027. We still think that we're in this super cycle, 20% earnings growth this year, double-digit next year, is still very solid. But this time of the year, the market is just scrutinizing everything that has to do with AI.
But Nataliia, do you actually have to take a calculated bet on how far or how near China is on some of these models?
Well, it's interesting because it's not really the first time we're hearing these concerns. We had these concerns a couple of years ago. So yes, it is concerning, but at the same time, this is not a new thing. And again, coming back to the point that I made, I just think that the market tries to find every single thing that can go wrong with the AI at this point.
Shona, I mean, the other big thing which happened 10 days ago, which we're still talking about, is some of these models, especially this latest OpenAI model, inadvertently hacking other platforms, Hugging Face. I mean, have we gone to the bottom of exactly what happened, whether it was prompts that weren't good enough, or can we make sure that it doesn't happen again?
We haven't got to the bottom of what happened, and actually more news keeps emerging. So we learned overnight that a sandboxing platform called Modal was also compromised by these models. A little unclear how that tied in directly to the Hugging Face attack, but we know, I think it's likely we will hear about these two particular models that hesitate to use the term broke out, but sort of went beyond their instructions, let's say, and hacked Hugging Face. I think we'll hear about other platforms being compromised too, but the news is emerging piecemeal, possibly because some of these platforms in question didn't notice that they were under attack so early, so these systems seem to have sat there for many hours, which isn't great, to be honest. So I think it's a little early to say exactly what the scale of the hack was, but I think we will hear more.
Sure. Does it feel like it's part and parcel of just testing this out, or could we see regulation? I don't know. Are there consequences of this?
I think we will see regulation because no one likes the sense that one or two companies have control, but actually they don't have control and no one's really regulating them. That's never a great place to be, particularly for technology that certainly they bill as particularly powerful. So I think we will, can expect at least some loose regulation. Maybe it'll be quite company-led regulation, sort of industry-led regulation, rather than something sort of from the government. But I think we will see some sort of movement towards tighter controls.
Does this have a direct impact on investors, or it feels like we're just at the beginning of trying to figure out where it ends? I've also heard of like a tech NATO type, alliance, but it feels very far away.
Yeah, I think, and I would actually agree with you. I think at some point there may be becoming regulation, right? As I mentioned, the market is just scrutinizing everything that is happening, but does it mean that it will absolutely impact the whole AI trade, right? We need to start and see what those models are, how they impact in the market, whether they're cheap to produce or not, what that it means for the capex spending. So I think at this point there are a lot of different unknowns. It's just the market tries to find the most negative news at this point.
Do you agree with that? In that it does feel like the market is testing because maybe they're trying to balance out the euphoria of the last 6 months?
Completely. I think, there's a big positive swing, and then now, any signs that that the kind of hullabaloo has been too much, I think, sends the swing back the other way. So, I think you see these big movements, and I feel like next week it could go the other way again. Who knows?
The roller coaster that is summer and tech companies. Thank you both for joining us. Shona Ghosh, our EMEA tech editor, Nataliia Lipikhina from JPMorgan Private Bank stays with us because we have to talk more earnings, and we have to talk about the Fed. Now, UBS has launched a new $3 billion buyback program after beating second quarter net income expectations as a 53% surge in equity trading revenue supported its investment banking division. And the bank's wealth business also saw stronger than expected inflows. Well, Verio Guy Johnson is following the results in Zurich. Good morning, Guy. So what are your key takeaways from the numbers and your conversations with Sergio Emotti?
The key takeaway is that this is generally being taken as a fairly strong set of numbers pretty much across the board. There are highlights within the numbers, but the market broadly has taken UBS higher today. It's not been the case with all banks. Look at what happened with Barclays yesterday. But today, certainly UBS is moving on the upside. One of the key standouts, as you say, has been the equity division. What has happened with that equity division? It is plus 53%. Why is that? Well, there's a number of reasons for it. The most prominent definite one, and I talked to Sergio about this, was the fact that we are seeing significant amounts of volatility in the market. There's a kind of huge transaction wave as a result that comes from that, and UBS is really benefiting from that. Is that sustainable, Francine? I think it's one of the key questions going forward. So I asked Sergio whether or not he thought this kind of volatility story that we're seeing, and you've been talking about what's been happening with the Cosby overnight, whether or not we will see ongoing bouts of volatility. This is what he had to say.
Look, if I look at the macro picture, the geopolitical picture, the ongoing debates, also the big dispersion we see in equity markets, and the pressures and on energy prices creates potential headwinds on inflation, and that may turn out to be something that investors will not really like, and creating potential volatility. So I do expect spikes of volatility to continue for the rest of the year.
So it's interesting. European banks have done well. They've done well in equities. UBS has done particularly well in equities, and these kinds of volatility incidents certainly are a big factor behind that. But European banks trail what we've seen over in the United States. Look at the numbers that have come out of JPMorgan. Look at the numbers that have come out of Morgan Stanley and Goldman Sachs. They're super strong. Is there a gap between where European banks sit in the equity story and where US banks lead in the equity story? And why is that gap? So I talked to Sergio about this a little bit, about this as well. And basically what UBS has done here has delivered this performance without any significant extra capital going into the equity business. So that's quite a positive thing. And the reason for it, he says, is that actually the equity business is there to serve the wider bank, the wider wealth business. This is a decision that was made back in 2012 after 2008, the crisis there, that the equity division is effectively subservient to the wider bank's needs. And as a result of which, it is a price worth paying in the good times to maybe underperform a little bit, to have the stability that maybe you will have maybe in the bad times. So that's an interesting side of things as well. But why is this gap existing elsewhere? Are we going to see it changing? And the sense certainly seems to be not. And I asked him whether or not it's just a cost of being a Swiss bank, because that's a huge debate here at the moment. Is there a cost of being a Swiss bank? And he said, you know what, maybe that's a price worth paying. I am happy to be a Swiss bank right now. And that's going to be heard loud and clear by the government and the regulators. UBS is happy being a Swiss bank, because there's this huge debate that is raging at the moment. The government wants UBS to have a higher capital standard. UBS says it goes too far. There needs to be a compromise. We're not yet there, but signs are that we're certainly moving in that direction. Francine.
Guy, thanks so much. A great interview, which you'll also hear in its integrity a little bit later in the program. Guy Johnson there in Zurich. Now, still with us, Nataliia Lipikhina from JPMorgan Private Bank. Nataliia, I mean, I don't know whether this is just symptomatic of the wider earnings story in Europe so far, which is they're fine, they're good.
I would just pick up on the discussion about the banks, because a lot of banks reported this morning, but overall what we're seeing is a very strong story. You're having obviously very strong investment bank division results, but also loan growth and deposits, they're all coming through. The ECB just hiked rates recently, and it's all going through the banks. It's a very similar story to the US. In the US, the banks kicked the earnings season a couple of weeks ago. It was very similar. Very strong loan growth, especially in commercial loans, shows that the whole capex activity is showing up for the banks, but also deposits as well as investment bank. So we feel like this is part of the market that is doing well. In fact, that outperforming the market months today. We'll feel pretty comfortable with the bank story. But also taking a step back, if you look into the overall earnings season, it's pretty solid, especially in the US. It's the 7th consecutive quarter of double-digit growth.
Yeah.
If we
really impressive, actually.
Yes, if you think about it's now ending, close to end at plus 27%. If you exclude some of the gains, it's much better than what the market expected even 3 months ago. And it's the 2nd consecutive quarter of plus 20%. Was there not to like?
And actually, when you look at some of the indices, I mean, you're expecting the S&P 500 quite a bit higher by mid-2027. Is there anything, I mean, is there one big bet that could derail? Again, if you look at the earnings, but the question marks around AI, what's driving this?
Yeah, if you look into what is driving the earnings, especially this quarter, for example, is still tech. So if there is one risk to our constructive view, it's the tech story. If the tech story is not panning out the way we think is, then probably there is a risk. But we still remain quite constructive. And as you mentioned, 82 to by mid-2027 is our forecast.
Nataliia, when you look at the Fed, I mean, there's a little bit of anxiousness actually after Citadel Securities, made a call for actually a Fed rate hike, or said that they would hike. Like, is there a benefit for delivering a rate hike now?
Look, when you look into the market expectation, the market is probably expecting a hawkish hold. I would characterize that. 30% market expectation that they will hike. We don't expect a hike today. We think it will all about, the guidance and how they think about the oil price. The CPI print recently was actually quite okay. It's all about the oil price at this point, which is seesawing, as we see. But we think that probably the Fed will be on hold today.
I mean, how much does the equity strength, but also in general markets, depend on what happens with the Strait of Hormuz, which frankly is anyone's guess, because there's diplomacy, there's talks, but actually then we go back to square one?
Yeah, you're absolutely right. The market is watching the oil price, but I would say the market will be, if oil is going up higher than 110, 120, this is where you may see a pressure on the equity markets, because this is the level at which, the market will be questioning what impact oil price will have on earnings. But it was interesting to see that oil sharply sold off earlier this year, right? So the market is still expecting that at some point oil may actually come down, and that will be the tailwind for the market.
Nataliia, thank you so much, as ever, for joining us. Nataliia Lipikhina, head of EMEA equity strategy at JPMorgan Private Bank. Now, coming up, a days-long pause in fighting in the Middle East ends, increasing the risk of a return to a full-blown war. So we'll have the latest on this next, and this is Bloomberg.
Earnings season is here.
There are earnings galore.
Some areas have done well. Equity trading has been an area of resilience.
Bloomberg is first to break the numbers.
Diving through the details of these earnings.
That is the weakest growth in more than 3 years.
With the smartest insights.
Are we seeing dislocations that point to something a little bit more severe?
If you look at where global growth expectations are, compare them to the start of the year, they're actually pretty similar.
But there is this uncertainty, and we haven't seen it in the results.
Continuing coverage on Bloomberg.
Has surged after the U.S. says it intercepted an attack on American military bases in the Middle East. Now, U.S. Central Command says it joined Saudi forces in retaliating with strikes on Iran-backed militants in Iraq. Now, the latest flare-up brings to an end days of relative calm. Well, let's get more from Paul Wallace, who leads our coverage in the Middle East and Africa. Paul, thank you for joining us. So just bring us up to date on the latest attacks.
So there was a lot that happened overnight. As you mentioned, these joint U.S.-Saudi attacks on the positions of Iraqi militias, that's very significant. The first time that we know of that Saudi Arabia has attacked Iraq in years. And this has the activities of Iraqi militias, many of whom are backed by Iran, has the potential to open up a new front. Iran is denying that it's involved with anything that the Iraqi militias have been doing recently, and they, in the past few days, have been attacking Saudi Arabia with drones, attacking Saudi Arabian oil facilities with drones. But even though Iran denies that it has anything to do with that, its links with these groups are very strong. It funds them, it trains them, and so certainly this will be seen by the Americans and by Gulf Arab states as part and parcel of the U.S. war with Iran. So it's a pretty dangerous escalation just days after everything that happened around the southern Red Sea with the Houthis and them attacking ships in Saudi Arabian territory. So yes, as you say, the sort of relative lull that we've had over the past few days seems sort of well and truly shattered for the moment.
So, Paul, what does this mean for the prospects of a truce?
It underscores, I think, just how far away the U.S. and Iran are from, a return to formal negotiations, let alone a permanent end to the war that sees the Strait of Hormuz reopened and Iran agreeing to a deal that curbs its nuclear program. That seems like a long way off at the moment. We're simply, or the sides are simply trying to get to a point where there is a ceasefire that actually holds and where traffic can pick up through the Strait of Hormuz, even if the vital waterway isn't fully reopened, and that's left to these sort of wider negotiations.
Paul, thank you so much. Paul Wallace there with the very latest, of course, on the Middle East. Now, Ukrainian President Volodymyr Zelenskyy says he discussed Patriot air defenses and diplomatic efforts to end Russia's war during his White House meeting with President Trump. Zelenskyy also described the talks as productive as Kyiv looks for ways to deter Russian attacks.
So now Putin is losing 30,000 his soldiers per month. This is big, too much losses, like President Trump says. It's many losses, but he doesn't want to stop this war. So now initiative not in the hands of Putin.
Let's bring in Greg Sullivan, our Russia economy and government editor. Greg, good morning. A very positive interpretation by President Zelenskyy. What was your reading of these discussions?
That's right. Both Ukrainian President Volodymyr Zelenskyy and the White House seem to strike a positive note coming out of those discussions. In reality, it's potentially a bit more of a mixed picture for Zelenskyy and Ukraine. On the one hand, Zelenskyy does seem to have warmer relations with Trump. You will remember that last year there was that infamous blow-up in the White House. Relations between the two leaders were a bit more fraught. That seems to be behind them now, with Trump even praising Zelenskyy and Ukraine's battlefield performance earlier this month. So that's a positive for Zelenskyy as he seeks to keep that relationship on his side. But Zelenskyy did go to the U.S. seeking air defense for Ukraine as it faces these Russian onslaughts and airstrikes. It's unclear whether he actually secured more air defenses in the interim. We do know that they discussed the domestic manufacturing of the Patriot missiles that Trump said he would allow Ukraine to do under license. That's going to take a while to get up and running, and Ukraine does have a shortage of these interceptors in the meanwhile. So he needed to secure those. It's unclear if he did or what comes next or how those next steps will play out.
Overall, where do we stand on the war? Is there any hope for ending the conflict?
Well, that's also a pretty fraught picture. We did hear from the Ukrainian leader last week that he met with U.S. envoys, or that he discussed with U.S. envoys restarting diplomatic efforts. But right now, there's really no sign that U.S. brokered talks will resume. They've been stalled since February as Washington has been distracted by or focused on the war in Iran. Right now, there doesn't seem to be momentum to return to the negotiating table. And from the Russian side, quite frankly, Putin has stuck to maximalist demands. He's still demanding territory that he doesn't control militarily, and he hasn't really shown a willingness to negotiate an end to the war or back away from those. So it's hard to see where a negotiation actually goes from here, but the first step would obviously be returning to the table, and right now there just doesn't appear to be much momentum towards that.
Greg, thank you so much. Greg Sullivan there with the very latest, of course, on Ukraine. Now, this is the picture across the board for European indices. Look, this is what I would overall say. First of all, UBS shares are gaining as much as 2.4%, but the wider picture is really what we're seeing with not only AI, but also the Fed. U.S. stocks are edging higher, traders holding off any major bets ahead of a U.S. interest rate decision. And then, of course, we're looking at earnings from Meta and Microsoft. Coming up, we'll be speaking to the chief executive of one of the world's largest testing, inspection, and certification companies as they raise their guidance. That's coming up next, and this is Bloomberg. Well, good morning, everyone. Welcome to The Pulse. I'm Francine Lacqua in London, and these are your top stories. The tech rout deepens over growing fears over AI spending. SK Hynix slumps despite a massive jump in quarterly profit. Banks get a boost. UBS beats quarterly profit estimates, and Deutsche Bank's fixed income trading revenue jumps. Plus, oil rebounds as the U.S. says it intercepted an Iranian attack on its forces, adding to inflation fears ahead of today's Fed decision. So let's get more on the Fed now, which is expected to hold rates steady later today. Traders eyeing a near 1 in 3 chance of a surprise move higher as the central bank grapples with inflation pressures. With a preview, let's bring Alistair Bull, one of our senior editors. Alistair, good morning. A hold is not necessarily a done deal.
Not at all. I mean, this is probably the most legitimately uncertain FOMC meeting we've had in years, and that's really down to a couple of factors. On the one hand, Kevin Walsh, the new chair, has been very careful and very cagey about not showing his own hand about his preference. He's deliberately said he doesn't want to provide forward guidance. And then you have half the committee who we know from previous projections want to raise rates, and the other half who sounded happy to stay on hold. And the ones who want to stay on hold have a pretty legitimate case. I mean, the CPI print was softer in June, payrolls undershot, and showing a little bit more patience now, holding off at least until September, would give them another 2 months' worth of inflation data that could validate the belief that some people have in the markets that inflation peaked in May and that the right strategy is to stay on hold. But the reason the market's pricing a third chance of a hike is there's good strategic reasons, not least Walsh's own very hawkish comments, to raise rates now, do it preemptively, buy a little bit of insurance, and also act well before the midterm elections in November. Francine.
Alistair, the Fed has kept rates on hold this year, so how much longer can they actually afford to do so?
That's going to depend on the data. If the data come in on side, it shows that CPI and inflation peaked in May, then staying on hold was the right call, and Walsh will be a hero. If they don't get those numbers coming on side, then they may have to go harder and go higher, and do so in the politically perilous environment of a tightly contested midterm election, which is going to draw a lot more fire from President Donald Trump, who, as we all know, wants lower rates. So, I mean, no pressure, Kevin. This is going to be a very tough call, and it's going to be a very interesting press conference where we're going to listen very closely to his words for guidance, if they do stay on hold, for how much more patience he has. Francine.
Alistair, thank you so much for the terrific briefing, as always. Bloomberg's Alistair Bull. Now, shares in France's Bureau Veritas surging this morning after lifting its sales growth target. Now, the company is one of the world's largest testing, inspection and certification firms. And as businesses navigate trade disruption, supply chain challenges, and the energy transition, demand for compliance and, of course, risk management is evolving. So let's discuss the outlook with Hinda Gharbi, Chief Executive of Bureau Veritas. Madame Gharbi, thank you for being with Bloomberg this morning. First of all, your share price is actually, higher, so congratulations on that. But your company really provides testing and certification across a range of industries. So what are you seeing in terms of economic outlook? Are you positive? Are you worried? Who's doing what?
Good morning, Francine. Look, we're very pleased with the results for the first half. The business environment is obviously complex. I just listened to the segment before. But what distinguishes Bureau Veritas in this market is we're a very diversified, decyclicalized group, and we've been working to continue to do so. So we are rather balanced in our view of how the market will evolve. We think our market fundamentals are particularly strong, even if the backdrop of the macro environment is complex. And we have been pivoting our portfolio and rotating our portfolio to align it with the fast-growing, resilient segments of this market. So our view is to continue to cautiously monitor situations like the Gulf, of course, the conflict we see in the Gulf. But what's important for us is to continue to control what we can, which is executing on our strategy.
When you look at the Middle East, how are these renewed tensions actually affecting your clients? And has there been an impact on your business there?
Well, there was some impact, of course, once the flows of oil couldn't leave the Gulf. There were some impacts on our oil and petrochemicals activity. But what we have seen, we've seen resilience in capital projects where plans have been maintained, a bit more softness on any of the OPEX activities where there is a little bit more discretionary decision making there. But overall, I would say this is a very important region for oil production, of course, and a number of projects continue to be maintained. But of course, some cautious on whatever could be controlled in the short term to preserve cash.
Yeah. I mean, given all of these geopolitical uncertainties, what do you think happens to inflation, and how are you projecting your own growth in the next year?
So it's an important question because inflation, of course, is something we monitor very closely, and we have built a good, I would say, response program to deal with that from a pricing perspective. So we work in over 140 countries, Bureau Veritas, and therefore we're exposed to inflation in different parts of the world. And we've developed, as I said, a response plan to manage pricing with regard to inflation. The service we do is an essential service, and therefore very necessary for projects, for companies to operate.
You've also acquired Lotus Work. I think it's the biggest acquisition that Bureau Veritas has done in the last 10 years, and it really specializes in critical tech facilities like data centers and semiconductor plants. I mean, this is the thing we talk about every day. So how important will that business be to your growth?
Is very, very important. We're part of our strategy to develop our buildings and infrastructure segment, which represents 30% of our business, is to move towards more complex assets. And data centers, semiconductor fabs are these kind of assets. Lotus Works specializes in commissioning and quality assurance and quality control of in the semiconductor space and also in the data center space. So we've been really developing our portfolio around these mission critical assets, and we think that will be highly accretive in terms of growth to the company, and they allow us to be in spaces that have high barrier to entry because the expertise is very deep, and the capabilities you need a long time to develop these capabilities for commissioning.
So in 5 years, if you look at some, I mean, there's questions about AI infrastructure, of course, but also volatility, valuations, potential bubble. If I speak to you again in 5 years, how much will testing of AI infrastructure be within your portfolio? How much will that grow compared to other businesses?
I think I'm more optimistic on the AI development. We work in so many sectors of the economy. The adoption is real. The capabilities of the technology are unusual in a way, and very fast adoption we have seen. So therefore, we consider that the underlying market continues to be strong, and we think that the growth is going to be strong. Just to give you a perspective, we started this activity of data center since 2017. We have multiplied the small acquisition we've made by 7 times since then. So you can see the kind of growth we've seen, and we think it will continue. Of course, the capabilities will be developed further to ensure we are expanding across the full services needed for these assets.
You also announced last month that you were in talks to sell off some of your oil and petrochemical operations. Are you any closer to sealing off that deal and sell them off?
Look, we've signed an agreement with Triton Partners to pursue this deal. I think we are on a good path. Of course, it's not done until it's done, but it's definitely a key element of our strategy to rotate our portfolio, and we consider that this activity for the future is not an activity we would like to keep, and that's why we've been working quite a bit now to achieve that. So yes, I'm rather positive that we should be progressing.
I mean, it's going to be a big year politically in France over the next 12 months. Do you worry about volatility? Do you think clients in France will delay decisions until the presidential election next year because they don't really understand what will happen?
Well, look, France is a historical position for us. It's our home country. We have expertise. We have a good position, but it represents, it represents around less than 20% of our business, rather 16% of our business when we operate in the rest of the world. So we monitor the situation very closely, and we prepare for ourselves for how the market will evolve. But at the end, it's not as big as one would think, being a French heritage company. So we're cautious. We monitor how things will progress, but we have a very resilient business in France, exposure to OPEX and regulatory activities, which tend to be stable.
Hinda, thank you so much for joining us. Hinda Gharbi, the chief executive of Bureau Veritas. Now, Rio Tinto has posted a jump in first half profit on the back of strong commodity prices. The miner says it will double down on efforts to cut costs and build cash by boosting productivity and selling non-core assets. The chief executive, Simon Trott, has been speaking with Bloomberg.
Iron ore remains a really strong market for us. We've been talking for years about the maturation of China growth, and you're certainly seeing that come through. It's been far more resilient than I think market pundits had expected because of that underlying demand. And whilst construction in China has slowed, you've seen a real pickup in export-related steel demand, so secondary and tertiary products, and that's led to fairly robust and stable pricing outcomes in the market. We continue to engage with all market participants, including CMRG, and so we, through the ordinary course of business, we renew those contracts, and that's the phase we're in at the moment.
You've talked about that market evolving, though, and obviously at the moment that the economy is in a K-shaped recovery, and the property sector, fixed asset investment, probably isn't going to come back unless they return to the old economic playbook. Do you see the plateauing going downwards? What sort of a sharper slowdown might you be envisioning?
We've certainly seen over a period of years that construction segment slowing down, and it makes up a relatively smaller portion of our book now compared to 5-10 years ago, whereas really one of the big drivers. And as I say, you've seen that demand being replaced by export related, not necessarily steel exports of themselves, but related to the increase in manufacturing within China and those products flowing to the rest of the world. I think domestic supplies and scrap have probably been a bit less in terms of on the supply side than predictions, and so that's led to stronger pricing outcomes and pretty good cost support. Is probably the last point I'd make. Increases in raw materials, particularly energy, has meant that it's pretty well supported prices on the right-hand side of the cost curve.
Obviously, more strategically important going forward is the role of copper, right? And prices demand has held up pretty well this year. Beyond Oyu Tolgoi, where do we look next in terms of guaranteeing future demand?
So one of the things we outlined today is around 70% of the raw material cost of a data centre comes from the materials that we produce. So aluminium, copper, lithium, as well as steel. And if you look forward, I mean, the spend next year on from hyperscalers, $1 trillion, and you convert that across, that's a lot of lithium, aluminium and copper, and so really excited about how we're positioned for the future. Fortunately, we've got Oyu Tolgoi, which is ramping up to the 500,000 tonnes of capacity. That ramp-up's proceeding according to plan, and really pleased with the way that asset continues to perform. Kennecott in the US, one of only 2 copper smelters, and then a big pipeline of growth beyond that.
Well, that was Simon Trott, Rio Tinto's chief executive. Coming up, an earnings boost for 3 of Europe's biggest banks. We'll dig into the details and hear from the C-suite. That's coming up shortly, and this is Bloomberg. The latest numbers from UBS really show that wealth management assets are beating estimates and trading revenue surging. The lender has announced a $3 billion buyback. Our Guy Johnson asked the chief executive, StanChart Emotti, about the buyback as it comes amid ongoing uncertainty over the bank's future capital requirements.
The issue is that what we have is this programs that we have to file with the stock exchange in terms of buyback programs that we can execute in theory over 2 years. And our capital return policy and ambition has been set at the beginning of 2026, when we say that our aim was basically to start with $3 billion and then assess the situation at the end of the first half. So what we do now is we have a new plan, a new program that, and we intend to execute it over the next 12 months. But the pace and size will be determined by our capital position, so staying at 14%, and also the ongoing development in the business, which we are very positive of, but also the ongoing discussion on too big to fail, like we did in the last 2 years. The language hasn't really changed.
The language hasn't really changed, so I shouldn't expect in 3 months' time some clarity on too big to fail.
The billion has to be seen as a minimum commitment that we will do, rather than putting a clear indication on anything more than that.
Equities, very strong. Plus 53%, I think, is the number. That's a nice number. The surprising thing is that you've done it without any extra capital. That's the real standout here. Let me ask you the same question I asked Venkat at Barclays yesterday. If you'd have given that division a bit more extra capital, if you'd have funded it differently, if you'd have provided more for it, could that number have been significantly higher? Are you throttling back equities at the moment? How high could that number be?
Not really. Actually, what we did, the point you raised is a good point, but what we did within the investment bank, we also shifted some capital from the fixed income businesses to the equity business to help them. But our focus is really, which I also believe that the numbers are very strong because they are mainly driven by intermediation activities. And rather than deploying capital in prime brokerage, but going back to your story, this is more about our strategic capital allocation at group level. We made that decision in 2012 our investment bank fits strategic ambitions that we have to support our wealth management clients, our institutional clients, our corporate clients, but with a defined capital allocation. So we had ups and downs in times in which was very rewarding to have that, and times in which you may have some opportunity cost. But when I look at the full results, a 23% return on allocated capital for the investment bank is pretty strong result. So we are very happy with it.
Okay, but let's the opportunity cost. Let's just talk about the opportunity.
Yeah, but the opportunity cost.
JPM did 86%. Yeah, could you have done that kind of number?
Yeah, but is not something. If and when doesn't matter, because I think our philosophy, our capital allocation, and our stock is rewarded by this business mix and not by taking opportunistic and tactical view on momentum in any of our businesses.
Do you think if you were a US bank, you'd do something close to, 86% for JPM, Goldman Sachs did 71%. If you were a US bank, do you think you'd get those kinds?
It's too hypothetical to answer that question. We are not a US bank, we are a Swiss bank, and we are very happy with that kind of
you can see where I'm going with that if you re-domiciled. Is there a cost to being a Swiss bank?
I think there are also a lot of good opportunities, but of course things have to be fully balanced. But I'm very happy with our results and what we achieved as a business mix, right? So if you look at wealth management, you look at the Swiss business, asset management, and the investment bank all together put up a very strong set of results.
UBS Chief Executive Sergio Emotti there speaking to Guy Johnson in Zurich. Now, it's been a big day for earnings at some of Europe's biggest banks. Standard Chartered and Deutsche Bank both beating profit expectations. Charlie Wells has all of the details. Good morning, Charlie. So what have we actually learned from these two banks this morning?
Well, Francine, we've learned that these banks really have been having a show of force, and that is translating into their share prices in the market. Right behind me here, we've got Standard Chartered up well over 4% this morning. Now, this is on the back of a very strong earnings report. Let's take a look at some of the standout points from that earnings report that we got this morning. Now, we heard, of course, this $1 million share buyback. Now, investors love those buybacks, but what's also really striking here, and we've been really paying attention to this, is strength coming from their wealth management unit. Now, the wealth management unit is really important for Standard Chartered, and there have been concerns about that. Let's flip and take a look at why. If you take a look at the share price of Standard Chartered this year, they are currently flirting near all-time highs, but if you look at early June, you can see that dip there. Now, that dip is related to Chinese authorities trying to limit the flow of money out of mainland China to places like Hong Kong. Where does Standard Chartered have a lot of exposure? Hong Kong. But investors are calm this morning, in particular because of the strength coming from that wealth management unit. We're seeing a return to force here for that share price. Now, again, that confidence is really giving the bank, a justification for that buyback. Let's take a listen to CEO Bill Winters talking about that return.
We're protected against whatever pullback or surprise may come, but we are investing fully in the business. So, yeah, $1 billion buyback, but we're investing, well over $2 billion of cash into our business year after year after year and growing. So, first and foremost, we invest in growth.
Yeah.
We take the surplus and return it to shareholders.
So that was Bill Winters talking about that buyback. Now, this has really been the theme of the morning, share buybacks. We also heard about a 500 million euro buyback from Deutsche Bank. Investors, of course, love that. That bank up well over 5% this morning. Let's take a look at some key points from their earnings report as well. We got that 500 million euro buyback, but also what really stood out this morning was fixed income trading, up some 16%, now beating a number of Wall Street competitors. I really want to zoom in on this because this really puts it all into context. Let's bring up and see how Deutsche Bank performed relative to some of its Wall Street competitors. You can see here that increase in the quarter year over year of 16%, beating a number of these major Wall Street players and also beating the average. So, of course, we see behind me Goldman Sachs up much more, but the average was 13%. So on FIC, crucial to Deutsche Bank because they did not have that equities trading business. They really got a strong beat here, but that wasn't it. Let's take a listen to CFO Raja Akram talking about the litany of records that Deutsche Bank had this quarter.
Not only is it a record second quarter, but it's also a record first half for us. But what's extremely pleasing is you mentioned the significant beat on investment banking, but actually we had record flows from asset management, almost 9% growth from our private bank. Our corporate bank is continuing to show signs of progress, which we assumed. Continuing to invest across the franchise. Capital position strong. We announced another buyback today. So I think all in all, I would say in this political and geopolitical environment, I think these are stellar results.
So again, Francine, that was CFO Raja Akram talking about that set of records from Deutsche Bank. And again, Deutsche Bank and a number of other European lenders really up in the markets on the back of strong earnings today.
Charlie, thank you so much. Charlie Wells there with the very latest on some of these banks. Now, Kering shares on the move after the luxury company reported that sales at Gucci topped estimates in the second quarter. The move is also sparking optimism that a long-awaited turnaround at Kering's largest brand is starting to take shape. Let's get more from Andrea Felsted from Bloomberg Opinion. Andrea, always such a treat to speak to you. So what were your key takeaways from the Kering results?
Well, Gucci isn't as bad as it was. It's going in the right direction, and it's not as negative as people thought it was going to be. It does seem to be a positive from Gucci, and that's what's got everyone so excited because it is the main driver of Kering's results and its share price.
Yeah, so what is selling well? Again, that we went from minimalist to maximalist. Like, is there a general trend of what people want?
I think we're moving away a bit from minimalism. Lipikhina CEO said they were having success with Gucci's leather bags, which is good because, they are the real profit drivers of the industry, and they've been in a bit of a slump. There are doubts about whether, not least for myself, whether Demna is the right designer, but this showed some sort of positive signs that his products were resonating with customers.
What's going on with Hermes? So they're better than others, but actually they're getting slammed in the market.
Yeah, the leather goods was slightly below estimates. There's just a feeling that Hermes was so much better than everyone else. It was untouchable for so long, and it's not. There are worries, particularly about the Birkin, the Kelly, the real drivers of that business. The one thing that I think has been good for Hermes, and I think it has really helped the brand, is all the footballers carrying these giant Hermes bags. I think there was a feeling that the Kelly, the Birkin was a bit overexposed. They tend to change hands in the secondary market at a premium to the retail because you can't get them easily. That had been falling, but I think the footballers have really given a fresh, lease of life into the Birkin.
Who knew? Football,
Exactly.
World Cup, and Hermes. There you go. Not something that I thought we would be saying a year ago. Andrea Felsted from Bloomberg Opinion with a terrific view, of course, on some of the luxury sector. Coming up a little later, we'll be speaking exclusively to the L'Oréal chief executive, Nicolas Hieronimus, on earnings after markets close this evening. Up next, Bloomberg Brief.